There's a right way and a wrong way to invest. In this video, we're going to be breaking down a financial plan and really mapping out the best way that you can invest when you do have a little bit of money saved. Now, a lot of people do have these steps kind of backwards. I've seen them kind of not corrected. I've seen individuals with a lot of money sitting in a financial institution, a bank, a credit union that have an exorbitant amount of debt, and that is not the way that you want to do this. So we're going to break this down with 5 simple steps. Number 1 being pay down your debt. That is right. Debt, especially credit card debt, is going to be far more expensive than what you have in an investment account, a savings account, a CD, anywhere that you're storing and holding money. It is going to be more beneficial to really pay down and eliminate that debt. Not only paying down that debt is going to free up a lot of the paycheck, allowing you to invest a little bit further, but also you're not going to be paying interest. When we look at credit cards, they're 22, 24% interest. Even when you look at auto loans, when you look at a bunch of different debt that people carry outside of the home is really the only exclusion that I would say add kind of a last resort that you're going to be paying off. But overall, the elimination of debt and all debt, we're talking credit card debt, we're talking vehicle loans, we're talking unsecured debt, any debt that you have out there. A lot of people ask, well, it's 0%. Yeah, it's 0% for only a certain amount of time. Majority of people do not pay off that 0% within that time frame, meaning that they are carrying more debt and they are carrying more high interest debt. Now, looking at our second one, building the emergency fund. This is another one where I see a lot of people want to go into investing, but they don't have an emergency fund, they don't have money set aside, and they also have not paid out the debt. So again, first step, paying down the debt. Second step, building out that emergency fund. Now this, of course, is going to be a little bit different depending on your situation. Now, the reason I say this, looking at your job, looking at where you work, looking at really the industry that you work in, this is going to determine if you're going 3 months, 4 months, 5 months, 6 months. If you're in a volatile industry, let's say you're in a very heavy sales role, you could also be, let's say, a mortgage consultant, you're selling mortgages, you get paid on commission. Any jobs of that nature, that can have a massive fluctuation in what you're getting paid on a month-to-month basis, is where you want to stick with the 6 month of the emergency fund. If you have jobs that are very well secured, that could require college degrees, that could require advanced education, again, depending on your industry, the very, very minimum that we're looking to do for an emergency fund is that 3 months. Again, depending also if you're single income or if you're dual income. So you do have 2 individuals in the home versus having one. Again, single individual, I would probably more cautious on the 4 to 5 months of an emergency fund, possibly even a 6 month of an emergency fund. Again, because you have to think that if you lost your job, how long is it going to take you to 1, find another job, and 2, how long can you keep all of the spending and all of the bills, mortgages, cars, all of that things until you can get back on your feet. Now, of course, this is going to be much easier if you don't have debt. Literally, guys, if the only payment that you are responsible on a monthly basis is your mortgage or your rent, your condo, whatever it may be, but your housing situation is the only debt that you have on a regular basis. I know there's little bills, little monthly bills, things of that nature, but overall, if you're just really minimizing the bills, the money and the emergency fund is going to go much farther, and it is going to last a lot longer because you're not getting it all eaten up by interest. Now, the next one we look at, number 3, is when you get into the smartest way to invest, boosting the retirement savings through Roth accounts. Now, I really stress this a lot. When you look at your Roth 401ks, if your employer offers them, if you look at your Roth IRAs, if you look at your HSA accounts, most of these are a very, very big tax advantage. I know you don't get an upfront tax advantage for a Roth account, but down the road, if you're looking at 10, 20, 30 years of growth, the Roth account will outperform your traditional accounts always. You will get to a point in time when you do the mathematical calculations, and big thanks to Dave Ramsey for really sharing this. When you look at the mathematical calculations and even breaking it down myself, there is no point in time other than a very, very short or one-off kind of niche situation that a traditional would outperform a Roth. When you look at the longevity of not having to take money out of a Roth, that is the game changer because you can actually let that roll for an incredible amount of time. When you're pulling money out, it is completely tax-free in the Roth as long as you meet the requirements. So definitely know those as well. But overall, when you start getting the compounding, again, when you're looking at 10, 20, 30 years of compounding interest on an investment that you're regularly making contributions to, it is going to be a game changer with how fast that grows. In addition, for a majority of us, if you do get to that 30-year mark, you've been putting away, let's say 15% since you've started working into a Roth account. When you get to retirement, you will be able to take out essentially less money, especially if you don't have debt, but taking out less money than it is actually earning just from the compounding of interest year to year, which again is going to perpetually give you an investment account that is growing, even though you're taking money out, taking less than what it is growing with that compounding interest factor. Definitely a way to boost your retirement. Now, overall, 48% of households in America, 48% guys, have no retirement income or no retirement plan that are over the age of 55. Let that sink in for a minute. So if you're at the age of 55 or greater, almost half of these individuals have zero for retirement, meaning there is not going to be any retirement in the near future. Now, also when it comes to investing as a parent, saving for a child's education is going to set them up for success, especially because 2024, we know there were major adjustments to your MESP programs, which means if you're putting money in there for college expenses, it grows tax-free if it is used for college expenses. Now, in addition, if it is not used for college expenses, it actually becomes a Roth account for you up to the amount of $35,000 if you meet the certain stipulations for that. And again, check out exactly what those are if you're putting money into the MESP program or kind of the 529 plans. Now, overall, this was one of the biggest hurdles when it came to college savings, was the ability to use the money. And then what was the ability or what happened to the funds if your child did not use it for education? There's a lot of cool things. You can transfer it to different children. If you have one that goes to school, one that doesn't, you can go ahead and use it as a Roth IRA account for you, which again is very, very cool to see that they're building it out this way. Number 4, invest in taxable accounts. That is what we're going to be looking at today when we continue our $1,000 journey every single week, putting the money in there. But once you get to a certain point of maxing out, your debt is repaid, you're putting money into your Roth accounts, those are maxed out, you're putting money into college savings, you're putting it into an HSA, then we look at taxable brokerage accounts, which again, one of the big things with those is you're investing money and you're allowing it and letting it to grow. Now, of course, you're going to get some taxes on this, but overall, it is the way that you're going to grow money. Honestly, when you look big picture, being able to invest money is going to buy time. So essentially, if you're putting money into an investment account, the investment account is growing. Those are hours that future you is not going to have to work because you're going to have that growth factor in there. If you're an individual making $25 an hour and I'm making $2,000 in this account, let's say every single year, that $2,000 is going to cover the cost in my time that it takes me to earn $2,000 at my job, which again can make a big game changer for literally the rest of your life. So bottom line, guys, if you have amount of money that is saving, paying off that debt, getting that emergency fund fully funded, looking at your taxable accounts, and making sure that you're investing money. Money sitting in a savings account is not very beneficial. It is going to sit there for an incredible amount of time, earning a little bit of interest, and it's going to be eaten up by inflation. All right, so let's hop over. We're going to take a look at our investment account, really break it down for this week, and see exactly where this is growing. All right, guys, so here we are sitting with our debt-free journey. As you can see, the value is almost 90K. So we have hit that. We're getting to the 6-figure mark, which is awesome. All-time gain, we're sitting at almost 14,000 right there, 54%. So we are doing a very, very strong portfolio with dollar cost averaging. Want to break it down for you exactly where we are. Again, we're doing this on a weekly basis. We've been investing in this account for just a little over 2 years, putting a lot into this and looking at our breakdown right down here. The money weighted rated return or weighted return, 54.33%. That is right, guys. We have seen a 54.33% return since we've been putting money in here since September of 21. We started last year with $1,000, and you can see we've even earned $1,000 in dividends already, almost $1,100, again, using that scenario of $25 an hour. Absolute game changer because those are hours that I do not have to work. Now, in addition, we do have $1,024.57. That is going to be invested in our portfolio tomorrow morning. And you can see portfolios with M1 actually have an auto rebalancing. So since my SCHD is actually down almost half of what we're investing is going into that portfolio or that essentially pie within here. Only 71 is going into the growth because the Vanguard growth, the VUG, is just absolutely crushing it, guys, with the build right here. The VUG, we're up 61, almost 62% in the last 2 years, which again, dollar cost averaging. Looking at 2022, where the market was down a lot, we bought, and we bought all the time. Every single 2 weeks, we were actually doing buys. Looking at the VOO, the S&P 500, we're at 48%. QQQM at almost 19, and then of course 7% on the SCHD. Now we know the Schwab US dividend equity fund, the ETF is not going to grow like we're going to see with the other ones. And the reason being that is our dividend one, where if the market is going down, it doesn't go down as much as the other ones as well, meaning that it can actually carry and still continue to pay out those dividends with that portfolio. So we also do the tracking on it. So we've been doing, again, the tracking for quite a while. This is the tracking that we do have in Excel. You can see right here tomorrow on 2/5, that is going to be the investment. So we put our another $1,000 in there. The rate of return that we have seen is at 54.33%. Cash flow is 76. So even looking right there, we have put in 76 in here and we are at 89. So almost a $14,000 market gain within the last 2 years. So incredible. Again, thinking of that in terms of $25 an hour, how much do you not have to work? That is $14,000 that we have made in this account. And then of course, a little over $1,000 in dividends. And the balance difference over a week is another $1,000 that we have seen. We've actually had two right there, almost two right there, and then one right there, one right there. We've even actually only had 2 weeks that were actually down. And of course, the second one, this one in yellow, is our rebalance when we bought the GBTC. So we actually got into the Bitcoin ETF. They have not been performing well at all. So unfortunately, we haven't seen really the performance out of there. So I went ahead and sold that. We took our $238 loss, but overall the growth factor, even looking from where we started, and these numbers, so even here, the VOO, we were at 5, now we're at 11.7. This is the dollar that it has grown. So we didn't put in the percentages, but looking at some of these, even looking QQQM was at $50. Now it's over 1,200 again with that rebalancing. I know it made a big difference right there. VUG was at 14. Now we're at 27. 161 for the SCHD. Now it's at 525, which again, as these continue to grow in a very positive nature, I am hoping this year that we are going to see some big fluctuations in the market. A lot of people are saying it's going to be a very positive year this year, but with some fluctuation. So these weeks that we have the down, I do like the weeks that we are negative, because that means the more that we're putting in here, we're actually buying a lot more of our ETFs that we're focusing on. Then when they go back up, and they will eventually, might take a little bit of time, but overall, when they do go up, it is a game-changing difference, because now I own a lot more shares of those ETFs. In addition, when it comes to dividends, the dividend payout is going to be much higher, because again, for that exact same reason, I own a lot more shares of the ETFs. And as you can see, we are 13 weeks in as we sit right now. So we actually started on 11/13. So 13 weeks right here, 13,000 invested, and we are going to continue this for a year. We are looking to do this for 12 months. Also, with the deposits that we have right here, we haven't had to borrow anything on margin. I think we did once or twice, but we always almost immediately paid it back. So we've gotten very lucky with how we've been kind of managing this with the financial plan that we have, and coming up with the dollars to actually invest without having to borrow it on margin. If we do have to, we absolutely will, to keep this going for all 52 weeks. Sorry guys, so that is going to do it for today's video. Let me know in the comments what you guys think about this, and as always, thank you guys for watching.